Let's welcome in an IT analyst, Rahul Jain, Vice President Research at Systematic Shares and Stocks Limited. Rahul, good morning. Do you think that this fall that we are seeing in most of the IT names, especially the large cap ones, is a buying opportunity? Markets are slightly overdoing the impact of the Q1 results?
Yeah, valuation-wise, definitely we can say that the valuations for some of the good large cap like TCS or Infosys, HCL Tech are quite attractive. But one thing is for sure that some of the gains may take time because these may have some short-term if and buts involved. As we know that most of the companies have said the Brexit impact is yet to be seen, and the only news flow so far has been the RBS event for Infosys, so which has been negative so far. So that is something one had to expect going forward from that valuation point of view.
Right, but from a valuation point of view, they are trading at very, very low valuations versus their historic average. Infosys, I saw, is trading below the Nifty PE multiple. That is something which is unusual.
Yeah, I must say that at this price of 1020 odd rupees, Infosys is still very attractive given the kind of transformation journey they are into, given the results they have come up in the last year, given the kind of even the reinstated guidance look like is definitely a positive. But the fact that they have not revised their guidance or any view post this RBS announcement, I think that is what somebody would look into the second quarter if there is a major revision on that front. And that is what is keeping the Infosys prices at such levels. And if it is not impacted, it would be a sharp run-up post the Tokyo announcement.
Right. As far as, some of these large cap ITs are concerned, they have a lot of cash on their books. They have done some buybacks. Say if the prices continue to fall or if they continue to be where they are and earnings continue to grow at a very moderate pace, you would expect buybacks, special dividends to come in?
Yeah, I think now the companies have realized multiple usage of cash. If you see, except for the last 2 years, it used to be only dividend, which was a common strategy. But companies where shareholdings are not significant and can be raised, which is true for most of the companies except for, let's say, TCS or Wipro, who are almost at par of the maximum shareholding possible. We could see significant buybacks that may come. The other fact is that now they are also looking for acquisitions. So, and it could be a little consuming, especially on the digital side where the acquisition cost could be much higher multiple of revenue or profits. So I think there would be a mixed trend wherein people may announce buyback if they are not having good inorganic opportunities. Otherwise, they would keep on investing even on an inorganic front.
Right, and the markets are worried about they paying slightly higher in terms of valuations, or just for growth they may just end up paying slightly more, which may actually impact their return ratios.
So what is happening is that return ratio would not be affected because since these cash are normally deployed at 5 to 6% yield, so any acquisition which they would do would definitely be better on those front. So it may be a little dilutive on the margin front, but it would be definitely a bit positive in most of the cases. And the smaller acquisitions where there are no profit on the digital side and all those, that would not affect the P&L balance sheet to that extent. So those things can be easily absorbed. So that is not a concern. The concern is whether you are buying scale businesses or whether you are buying capabilities. So that is what one need to closely monitor.
Right. Do you think markets have adjusted to the fact that the earnings growth will now not be in the range of 20% YOY or much lower than that, 12-13%, or maybe slightly even lower than that?
So yes, the new normal is 10 to 12%, and this has been the case for last 6-7 quarters now. So gone are days where you would see several companies growing 15% plus. I think 10-12 is the more realistic number on a sustainable basis.
Right. What would be your top picks in the IT pack? Start from the large cap space and then probably the mid cap ones.
So actually, we are seeing visibility as a prime most factor in our picking. TCS clearly remain our best bet, given that the kind of growth they have across the matrix. So that remains our top large cap pick. We like Oracle Financial. It's a product play, very large opportunity, leader in the segment, high operating margin, business space looking good. So that is another large mid cap or mid cap we can say. And there's another company called SQS, a small company, 1,000 crore market cap, but have strong migration opportunity from parent. Visibility looks strong on the revenue and profitability. So that is our preferred pick in the small cap. So these are the three stock which we are pitching right now.
Right. Let's look at them one by one. Let's start with TCS. 3-4 quarters of continuous miss, but you expect markets, whenever they rebound, TCS will be the biggest beneficiary.
So I think TCS did well after this quarter as well after Infy's bad result. It's just that after the RBS news, it was seen more as a sector concern, and that's how it got corrected from 2750 odd to the current 25 odd level. I think which is a more like a sector news. If they again deliver a good result in the coming quarter, I think there's a good money to be made here on TCS.
Right. Just a word on Oracle Financial as well. So OFSS or Oracle Financial Services, the play over there is any sort of corporate action or any delisting, or it's purely because of the business.
Yeah, our call is definitely on the business front. They are seeing good traction in the new license sales in last several quarter, which is the defining factor in this particular industry. So that is the key factor why we are pushing it. On a news flow front, I think there is always this kind of news whenever there is an MNC in action, but our call is purely on the fundamental business perspective.
Right. I just wanted to ask about HCL Tech as well. Considering that other companies were not that great in terms of numbers, HCL Tech did well in terms of revenue growth, margins, the commentary that they gave. Still, it saw a correction. Is that looking attractive because it's performing when nobody is being able to give growth?
Yes, so HCL Tech has done a good job in terms of scaling two business segments, which is contributing roughly 60% plus revenue for them, engineering and R&D as well as IMS. So they would continue to excel in that space, which would ensure good growth, sector-leading growth even in next couple of years. And valuation definitely are attractive. So once there is a little sanctity on a macro scenario, I think this would also be a stock which would be in the favor.